Good morning, everybody. Welcome to the Flow Show, Tuesday, 24th of September. Nice to welcome you all here, all you lovely viewers. And we've got a few bits and pieces to get through today. Lots happening, a few kitchen sinks being lobbed around by central banks. Before we do so, don't forget, you've only got 6 more days to take advantage of our sale price on offer for joining the ForexAnalytix platform. So as you can see the details there, just go to ForexAnalytix.com and sign up there. I believe we've had one gentleman who signed up for 5 years yesterday. Such was his excitement at that sale price. So grab it now. Whatever price you get now, you'll keep for as long as you subscribe. You won't get mugged off at renewal time with a price hike. So get it while it's hot, as we used to say on the old markets down here in London, or up there in London. Right, let's get stuck in. It's just me today. K-Man's got some personal stuff to attend to, so he might be gone for a few days. So it's just me, myself and I, and maybe I'll drum up a guest or two later in the week. We shall see. Right, let's get started in China. And as I've been warning, China really needed to do something to help their economy because the current measures haven't been working. And it seems that we've got the PBOC listening to the Flow Show as well, because overnight or this morning they had this meeting, this meeting between the PBOC and their 2 regulatory boards, and they have decided that at some point, to be decided, they are going to cut the RRR rate by 50 basis points. They're going to cut their 7-day repo rate by 20 basis points. They're going to cut existing mortgage rates by 50 basis points. They're going to cut the MLF and LPR rates by 20 to 30 basis points apiece. They're going to create a new monetary tool to allow funds and other financials to access PBOC funding to buy stocks. And the head of the China Securities Regulator said they will issue guidance for medium and long-term funds to enter the market. So it is kitchen sink from the PBOC, trying to get the economy moving back the right way, trying to prop up the property market and generally bring a bit of a boost to China. Will it work? Who knows? Now, as I said, they haven't actually pulled the trigger on any of these rates. These are going to be upcoming rate changes, but they've decided to drop the bomb on them all in one go. What's not good news, particularly for me, is the fact that the yuan has continued to weaken. Dollar yuan has continued to weaken, i.e. the yuan strengthening. We've now had to move down to 703. Now, this goes against my strategy and thoughts that if they did throw the kitchen sink at this, we would see the yuan weakening, i.e. dollar China going back up. That hasn't happened. So when I have a plan and the price doesn't go according to that plan, I get very cautious. So I'm not adding to my longs right now. At the very most, I might add down into the big 7 figure just as a little feeler to add to the position there. That will be my limit though. But I'm not got any great conviction about this trade now, nor have I got any conviction about adding little bits and pieces. Now, as I said, I have been keeping this trade very small already, just because of the price action, the way it's been going. But the fact that they've done this move and we haven't seen one weakening is, as I say, it goes against my thinking. And if I'm wrong, I'm going to protect losing too much money. So if I get a rally, maybe back to 706s, 707s, I might even cut out the whole trade, try and take as little loss as possible, or try and scratch it and then reassess the position. It does seem in this move that they are happy to continue to let the yuan strengthen, even though they haven't explicitly said so. So it's a case of let the price action do the talking. So a big set of policies from China. And so far, it's being seen and taken positive in 2 formats, in risk as well as in Chinese yuan strength. And I'll talk about some of those risk assets shortly. Right, moving on from China over to Japan, and it was PMI day over there for those guys. Manufacturing coming in a smidge softer at 49.6 versus 49.8 previously. Was expected to go up a pip, but that's still in contraction. However, services, that did improve by 2 pips to 53.9. We've had Eurida out this morning as well, saying it's appropriate to raise rates if trend inflation heightens in line with our forecast. And if trend inflation moves to around 2%, it is desirable to move our policy rate to near levels seen neutral to the economy and prices. We will raise interest rate if the economy prices move in line with our forecasts shown in our quarterly outlook report. That's a key line because I believe the next meeting in October will be their next quarterly outlook report. So what goes on in there could give us a bit of a clue as to whether they're closer to hiking or not. He says the financial market is still unstable, and speaking on the yen, he said the unwinding of short-term speculative yen positions, which was partly behind the August market rout, has likely run its course. So that last hurrah, shall we say, in down move in yen pairs, particularly dollar yen, he's saying that was the unwind of speculative move, all this going up here. He says that's probably almost unwound, and he would know because he'll be in close contact with a lot of their banks, agent banks and whatnot, so they will know what flows have gone through there. Over at the RBA, they held their rate as expected, but we did get a bit of a shift in language. It was a bit of a sideways shuffle, shall we say, rather than a big step. The statement said that inflation remains above target and is proving persistent. The board is not ruling anything in or out. It was RBA's Bullock who really did the shuffle to a less hawkish stance. She said recent data has not materially affected the policy outlook. Rates are going to remain on hold for the time being. That was all pretty much standard as per prior meetings. But then she said that the board did not explicitly consider a rate hike at the meeting. Now, in pretty much the last few meetings, a rate hike has been discussed, and the case for and against has been discussed in detail. You only need to read the last minutes to see that. So that was the sort of language I was looking at for a shift from the RBA, that they remove explicitness to hiking, and it looks to be the case. So she said they did not explicitly consider a rate hike at the meeting, and the format of discussion changed at this meeting. She said in the near term, the board doesn't see interest rate cuts, but the board did discuss whether to change policy messaging. We are not thinking of what size we might eventually cut rates by. Then she added that the pause may support the Aussie dollar and help with inflation. So a bit of thinking behind why they're staying on hold is that it might give a boost to the Aussie dollar and help with their inflation fight, using the currency to do the job for them. So, as I say, a little bit of a shuffle. It looks like the threat of hikes has been pushed further off the table or towards the edge of the table. So, as suspected, it was always going to be a high bar for them to hike again, and it looks like they're coming to that conclusion as well. I still won't rule it out completely. They're going to keep the optionality, but the market has already been sniffing that move for quite some time. So we got a little bit of a dip in Aussie dollar over that. You can see exactly when that comment came out this morning, right in there. So Aussie dollar was just hitting its highs, and then those comments dropped, and well, we came down to near 68, though we have bounced back since. So a bit of a shift, but it's not changing anything much as far as Aussie dollar's concerned for now. Coming over to the UK, and we had CBI industrial trends orders. So this is more sort of manufacturing production data out yesterday while we were in the middle of the flow show. Came out minus 35. So again showing a bit of stinkiness, shall we say, not stickiness, for manufacturing in the UK. These numbers tend to be glass half empty most of the time anyway. But I couldn't tell you. Let's have a look, see when the last time it was positive. Oh, look at that. Back in 2022, the last time we had a positive number from there. So things aren't as bad as that's making out. But as I say, they're a bit of a glass half empty mob, the CBI. BOE's Bailey popped up on local news down in Kent and said inflation has come down a long way, but we still need to get sustainably to target. So keeping the rhetoric from the BOE meeting last week. A bit of data this morning from Germany. You won't be surprised to find out it was worse than it was last month. IFO business climate came in 85.4, down from 86.6, lower than expected. Current conditions, lower than expected, lower than last month. Expectations, though, came in as expected, but still lower than last month. So still no turnaround or any signs of a turnaround in Germany just yet. ECB's Lagarde says inflation hasn't quite been defeated. She said Powell and her talk, but they don't coordinate. All these central bankers having their little backphone conversations with each other. ECB's Muller says it's reasonable to expect more cuts if the outlook holds. Yesterday we got the S&P manufacturing and services data from the US, and probably the biggest take from that was that it wasn't an outright collapse in any of the numbers. Manufacturing did soften a bit to 47.9, was expected to rise. So it came in at 47 from the prior 47.9. Services, though, that did tick down, beat expectations, but it did tick down a couple of pips, but still a healthy looking number. The composite as well looking healthy too. So again, the market really took that as a sign that things aren't perhaps all that bad in the US after all. And we saw a further move on risk on the back of that, which I'll talk about in a moment. Fed heads were out in force yesterday. Fed's Kashkari says the balance of risks have shifted towards the risk of further labour market weakening, higher unemployment. He said the Fed's 50 basis point cut was the right decision and reflects progress on inflation and the softening of the labour market. But then he said 25 or 50 BP cuts, both would have been reasonable. Bostic says the economy has been normalising more quickly than previously thought, and monetary policy needs to as well. He supported a 50 pip cut as a compromise between remaining uncertainty around inflation and risks to the jobs market. He said a half-point cut at this meeting does not lock in a cadence for future rate cuts. The Fed is not in a mad dash to neutral, and in favour of not rushing judgment or assuming the job is done on inflation. He feels the neutral rate is in the 3 to 3.25% range. The ever-excitable Fed's Goolsbeast is in a little bit more of a rush. He says many more rate cuts are likely needed over next year. Rates need to come down significantly. A lot of cuts are to come over the next 12 months if conditions continue like this. He says he's comfortable with the Fed's 50 cut because it shows a focus on the risks to employment, not just inflation. He says overall the economy has some warning signs and some strength. He says a 0.7% increase to unemployment over a year is usually a warning sign of economic weakness. He says rising delinquencies is another warning sign. So very dovish, bearish sounding Goolsby there. I think he's a voter next year, so he's going to be in the hot seat next year. So we'll have to see. He is a very excitable chap. It's always something's happening big one way or the other. Right, expectations for rates. We're seeing an increase in ECB rate cuts for October. Now at a 40% chance. They have been flickering around that 40-50% mark. Expect that to pick up as we move closer to the next ECB meeting, particularly if we keep getting stinky numbers out of the Eurozone. Reuters run a poll of their economists for the S&P this week, and 30 out of 32 expect them to cut 25 pips on Thursday. We've got some goalpost moving by the UK Chancellor. She's considering changing how the government's fiscal rules are calculated, which supposedly will allow them to nab billions more pounds in capital spending. So if you don't like the rules, change them, and then you can create money out of nowhere that wasn't there before. Amazing, eh? Trump, if he gets in power, he's threatening John Deere with tariffs if they move their manufacturing business to Mexico. So he's already getting the threats out to businesses if they jump ship out of the US. And over in Russia, the Kremlin's been out saying we have no alternative but to achieve all our aims in the military operation in Ukraine. So that keeps the rhetoric going over there. No hint that we're going to get to any resolution anytime soon. That's it, all I've got from the news headlines and bits and bobs. So we'll get stuck into what's coming up today first. I don't think we got an awful lot, bit of house price data to kick us off later on. A few more speakers, Fed speakers popping up too. We do get the Conference Board consumer confidence number. So again, just coming so soon after the Fed, that might be a number that might get the market moving a bit if there's a big variation. Aside from all the components, the headline number, look for those inflation expectations as well. A little later on, we got Macklin popping up as well. Not sure what he's speaking about, but the last thing he spoke about, I think, was AI or something. So we'll see if he's got something to waffle on about. Right, so what's happening in markets? So really since the last couple of days, particularly yesterday and today, we're seeing a broad risk on move. So we're seeing commodities higher, we're seeing commodity FX higher, things like the CAD, the Aussie, Kiwi, you name it. If it's got strong commodity links, they're all gaining. So although in some places it looks like dollar weakness, that's more a mechanical move on what's going on in the broader market. Just to highlight the point quite clearly, I was looking at this morning, copper having a pretty decent move up this morning. So this may look a bit strange. It's coming as a bit of a surprise to me, because we've seen this risk move after the Fed have gone a big 50 basis point cut and started their cut cycle. Copper's up after the PBOC threw some kitchen sinks at their issues as well. So it seems the market is taking all these rate cuts not as a sign that central banks are cutting just to keep growth underpinned, particularly in the US, but they're taking these cuts as a sign that central banks are doing something to stop growth weakening further. So it's looking like it's a bit of a boon to growth for the future, i.e. these rate cuts will stoke growth rather than just stop it from falling. For right or wrong, the market's thinking behind that. As we know, the market's got bigger pockets than we have, so we just have to go with it for now. So we are seeing a rise in commodities, oil's up, commodities like copper's up as well. We've obviously seen gold still up around its all-time highs too. Silver was going up as well. So we are in a bit of an uplift in commodities and risk, as I say. Is it going to happen? Are all these rate cuts going to spur growth rather than just stop it falling? Who knows? Jury's out. But if you just base it on what the US has been doing, we're not seeing any horrendous numbers still. So it could be a bit of a tightrope before either things turn sour or indeed they might improve further. Certainly manufacturing needs to be the first thing that really turns around. If we start getting some positive numbers, early indications, particularly from the PMIs, then you're going to see a whole wave of moves into commodities and a whole big wave of risk on. So that's what I think the market is trying to play at the moment. It's going to have to rely on the data as to whether it's going to bear fruit or not. So as I say, that's what I think is really driving markets at the moment. So assets like Aussie dollar, as just said, they are gaining, and this one's bouncing back after that move from the RBA, creeping back up to the highs. Okay, I think it's a little bit held back from this shift in the RBA, but I wouldn't be surprised if we go on to tackle those highs again and maybe even take them out. It is quite a significant level up here into the high 68s and 69s. It's an old fib from the 2021 swing down right in there, 68, 70s. Bit of an area as well, bit of a zone around that up into 69. So it's another big level. If we were looking at 68 being a big number when we were coming up here, 69's that little bit bigger. Okay, so we haven't yet still got a breakout in the Aussie. If we're above 69s, then I think we're cooking, and we're really going to have maybe a decent move on our hands. But it's all going to have to be driven by the data. Kiwi as well, that's in the same boat. It's got itself back above the 62.14 figure, coming up to test these prior highs that we had the last time we had a rally up here, up into the 63 figure. So if you manage to bust that out, it does look a quick return up here. So again, if it's got some oomph behind it, then we could be seeing a break there too, and these heading higher. So that's which way the snowball's rolling at the moment. Don't ask me what's going on in dollar CAD. It's all over the place still. At one point yesterday, looking like it was on the same train. We had a move down through 135 as oil was rallying, and then oil stopped rallying and came off, and this one still kept going down. So this one is really flaky at the moment in terms of what it's following. And what are the drivers behind it. But it is, again, looks like CAD's weakening again on this risk move more so than what's happening in the dollar. So we know the range to play up into this 136, 136.14. That may become another solid zone. Again, it's already looking like it's becoming resistance around that bottom of the zone after we had this move. So I expect that to be sticky again. But now we might be testing these downside levels, and we'll see what happens down here in this zone. We had a little break, got close to my next level, we had a bounce, and then the bottom of the zone became support again. So this zone is going to be important. Through there, we'll test this low. If we hold that low, then we're probably going to range for a bit, and we might get a look back up 135s, 136s. If we do break here though, then I think it's going to need a bit of influence from oil. So if oil's breaking up, 70, 75 bucks, maybe up towards 80 bucks, then the CAD is going to strengthen further, and we might get a push down. Where that goes again is anyone's guess, but down towards 32s, 31s, that's going to look pretty juicy from a tech point of view. Just if I bring it onto a wider chart here. This is quite a big level down here, big area down here. There have been lots of traffic through there, and especially down into the 130s, which is a big old zone. But we're far away from that yet, so let's not get too excited. But at least the drivers for now. Euro sterling, that's continuing its march lower. It was holding up for 5 minutes around that 183.40s area. Which was those lows, but as you can see, we were messing around there for a little while, then we broke it, and it's immediately become resistance. So that tells you exactly what the market's doing with this one. It's always difficult to try and get this one in a reasonable focus in the time frames, because there's so much time between when we've got all these lows down here. So we're through there. It really is down to the big figure now. We're going to see stuff around 83, but then 82.76, as you can see, is a bit of a level, and then much bigger than that. I'll just go into a cleaner chart. We get down to the 82 level down there. So 3 or 4 levels still to go, but we could be heading for a move down there if this keeps continuing. And that's quite possible because cable is continuing as well, still the strongest one. Let's give it to these fibs for the moment. I'll draw them back on later. Pretty strong rally. It shows no signs of stopping. 134 figure, we're always going to find a bit of trouble into. The cable, though, from a wider standpoint, is just really quite messy. It's not as clean in terms of the wider levels as some other pairs, just because it's seen a lot of action, obviously, over the last few years, what with Brexit, pandemics and the like. So 134, probably take the figures and half figures for this one as some of your main points, but otherwise get up to 135 to 136 is that's a bit of a big traffic area. So that'll be my main area to watch if we keep going on this one, but no signs of this pulling back just yet. So as I say, that could keep euro sterling going for a bit longer anyway. Let's have a quick look at stocks because they're on the move as well. S&P, it's making fresh highs, or trying to make fresh highs anyway. Again, it's coming in. It's just nicked a high above this last one. You could call it a hold or whatever, but even if it moves like this, just nick a new high by a couple of pips, that still shows that the market wants to go. But you know, we might be able to call this a level up here now. If we see a bit of a pullback from here, we'll have at least a very short-term intraday double top possible, and then we'll see if we want to dip back. But if we don't dip back too far, maybe not even as close to the 57 figure, and we turn up here, then we're probably going through, if we're not going through already. So again, it might be a case we just have to sit on our hands and wait for a more definitive top to form. Yes, Brown, the egg is cracked. So might have to just, as I say, wait for a more definitive top to form before we start thinking, or before shorts can start thinking about piling in against that. We know the levels down below that we have to rely on. As I said, 5,700 in the first instance, but this zone here is the main support zone because that was the big old break point there. Gold, I know all you gold fans are hovering around. So a potential fake out of this one. We had this move yesterday, you know, as I said, on the or this morning on the risk bandwagon, particularly coming around the PBOC time when they're dropping all those bombs. So a bit of support for gold, but it hasn't lasted again. A bit like this move. We had a little pop above on Monday, didn't last, came back below. We've had another move above, hasn't lasted. We've come back below. It's looking like it might resist again. I don't know. We'll see how that develops. But this type of move, it smacks a bit of exhaustion. Okay, when you try these, hit a level, try a break, fail, it just suggests that maybe the market might be finding a bit more of a balance. It's making it a bit tougher to break up. But if we go above there now, in this move, say over the next couple of hours, get back above there, then probably we are going on to make new highs. But if we hold this level again, let's say through the rest of the day, then that's going to maybe solidify this area as a bit of a top. And then again, if that happens, we'll probably see a bit of a pullback, and we have to watch for where that goes to. So a bit of a coin toss here at the moment as to whether we're going to plow on up. We're still making higher highs and higher lows. So, you know, that pattern is still in play, but now we're at a bit of a crossroads here on what this is going to do from now on. I did mention oil, UK oil, busting up into the 75s now. Again, a bit of a risk on move, but obviously the ongoing dramas in the Middle East is still playing a little bit of a part here as well. US WTI also creeping up. We're right into an old traffic zone here, 72, 73s. So this is going to be a fairly big test for US oil markets, at least. You can see there, it's a big old traffic zone. So what happens here could be a bit of a decider. If we crack on up through there, then you're going to see FX, as I said, like CAD gaining further. In the yield space, notice that we're getting a move more at the longer end than we are in the shorter end. If you compare what's happening to 2-year yields here. Let's come on to a bit of a shorter time frame. We're still nudging along the lows here, not in a rush to go higher. So this is reflecting the market's view of short-term rates. At least the Fed's cutting. They're going to be cutting through potentially the rest of this year and into next year, or every meeting as far as Gall's beast is concerned. So we're seeing short end yields relatively stable, and the long end has been picking up, though, creeping up further. Again, that's a potential sign that the Fed may get rates to zero, and if to neutral, and if that neutral is stimulative for the economy, then we'll see the economy grow, inflation grow, wages grow, inflation pressures, so on and so forth, and thus rates may have to go higher again. So again, this is a bit of a risk trade as well, risk play as well, just on the path of rates and what that may induce. Right, what do you guys and girls got going on? Ali, you're late. Where's your late note? You can't be late for the show, otherwise you have to put you in detention. You'll have to write 100 lines. I must not be late for the flow show. Right, let's see what's going on. Does this happen to me? Right. Last night you were tired and placed some orders in dollar Swiss. Somehow didn't put your full slot size in. Not sure what you're saying there, Ali. You didn't do as much as you wanted to, or you did more than you wanted to. Anyway, looking at dollar Swissy, which will keep a bit of a beady eye on as we're heading into the S&B this week. I keep this one fairly clean because I don't trade it an awful lot. I was looking to see if we did get a move back down to this low down here, maybe to try it, but we haven't got close to that. Still, well, I don't know if it's going to be possible over the S&B. Now, if they're going to cut, it's likely the Swissy weakens further. But we know where the trouble zone is above 85s, 40s, 50s into that level up there, which has been resistance after we had a couple of goes at trying to break it. On the second attempt, we found it as resistance. So that's the upside level to watch. Down around these lows and into that low is where we need to watch on the downside. So really, in the middle here, it's a coin toss still. I think you've got to look at going with a break either side. If you're breaking down below this low, then we're going to be heading much, much lower. And conversely, if we're breaking up above here, then we're heading up towards that next zone, 87s, 87.5s, 88s. But be careful if that happens over the S&B, because the market's expecting 25, but there's a risk they go 50. If we do break above there on the S&B, going to 50, something like that, you'll need to make sure that that break is confirmed or that break is solid. You don't want to get faked out by a quick move up and then think, yeah, it's going. And then 5 minutes later, we're back under that level. And then you're caught offside. So probably one way, if you do break here on the back of the S&B, you want to wait for a confirmation. So retest to that level and holding. Well, shit happens, Ali. You didn't place your full lot size, trade size. Don't worry about it. All you need to worry about is making money, and more so not losing money. So if you do that, it doesn't matter. Get the trade right. Don't worry about you didn't make X amount of dollars and cents and whatever on it. Okay, so if you get I'd rather be right and make a little than be wrong and lose a lot. Okay, so we all do things like that. Look at it the other side. There's plenty of people, and plenty of us have done it, where you've put in the wrong lot size, put in far too much than you wanted to, and then you shit yourself that you've put on a huge trade that you didn't mean to. So yeah, don't beat yourself up about it. Just play the trade as you would whatever size you wanted in the first place, and just try and make some money off it, mate. You plan to go along Aussie on a break of 69. Long-term trade. Well, I don't know. If you're going to go long at 69, don't you want to buy a dip at 68 and save yourself 100 pips, seeing as that's where the nearest support is. If we get a dip down there, yeah, it could be setting up for a break. That I will admit to, because this is, as I said earlier in the show, this is a decent level up here, 69s, but it stretches up a bit. Okay, so we've got a couple of highs in there, right into 69s, and then 69.80s. You've got another zone up there. So yeah, if you get a break, yeah, it could go. But again, you've got two ways to play it. You can go with the initial break, or you can wait for a retest and just get that confirmation. But like I say, might it be a bit more? Oh, you're already long. Okay, you're already long 68, 30, 40. Gotcha. No worries, mate. All good. Right, I'm going to call that a day for today, as far as that goes. I'm on my Todd. So I think we've looked at enough. And don't forget, if you've got something you want to talk about specifically, put it up in the chat. I'll keep an eye on it. Have a look, and we can look at any pair, any asset you want. Doesn't faze me what we look at. It's pretty easy to draw some lines. Right, have a great day, everybody. Trade safe, and we will see you all tomorrow. Thanks a lot.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.